So we talked about simple interest. Then we talked about compound interest, is when you got interest on your interest. Then we talked about installment buying, and the first thing in installment buying was loans for like cars, where you're going to make the same payment over the life of the loan. The interest is all calculated up front. Then we did credit cards, which was laborious. The last thing is we're going to talk about the idea of a mortgage. At some point in most of your lives, or maybe all, or maybe none of you, you might end up with a mortgage. You buy some sort of apartment or house or condo or something, and the purpose of a mortgage is it's something that you're buying that's more of an investment, not just something that you're buying that you're going to pay off really quick. So a mortgage, so the first blank is pretty disappointing. A mortgage is a long-term loan where property is given in exchange for a pledge of repayment. So you are saying up front that you are going to repay. You are being lent money. You're paying significant interest in order to do that. But the whole point of mortgages is you do something when it's going to be long-term and things are hopefully going to increase in value. Now, I am not super familiar with financial stuff. I'll be completely honest with you. This is not like something that I get a lot of energy from. So I know a minimum amount about mortgages, and so I'm sharing my minimum amount with you. Some of you might love finance and things like that, and so you probably could know more than me about this right now. The other thing that I'm just going to tell you about a mortgage is some banks let you buy what's called points. Points are prepaid interest. What banks will often do is say, okay, the mortgage rate we have is, let's just pretend 5%. But if you want a lower mortgage rate, they'll let you like buy a point to reduce that by 1% or 2%. The value for you is if you are going to keep the house for 20 or 30 years, you're going to save a lot of money. And the bank is going to get an influx of some money right off there. Actually, when you buy points, the bank actually is going to lose a little bit of money. Not that we should feel sorry for them in any way. They make plenty, but it is something that can be helpful to you. So 1 point is 1% of the loan amount. And then a lot of banks and places, they have a limit on how many points that you can actually buy. Otherwise, you could buy enough points to reduce the interest rate to 0, and then the bank's going to not be able to make any further money, which banks hate that. So there's usually a limit. Usually you can buy 1 or 2 or 3 points, depending on what the interest rate is like. So this first example is just an example to review a little bit about percents, and also incorporate this idea of points. So here we go. I want you to help me with this one. I'll help you with the points, the last part of it, but the rest of it, this is just review of using percents. It says the Martins wish to purchase a house that's selling for $249,000. They plan to obtain a loan from their bank. The bank requires a 15% down payment, which gets payable to the seller, and a payment of 2 points payable to the bank at the time of closing. So you're going to do the first 2 things for me, and then I'm going to help you understand how to work with the points in the third thing. So you do the A part, what's the amount of down payment? And then the B part, that means that they're mortgaging how much? All right, so the first one is, what's the amount of the down payment? The down payment that is being paid is 15%. So this is just real quick a review of what we talked about as far as percents. We're just going to calculate 15% of the amount of the house. So the A part to the problem is just 15% times the $249,000. Banks will usually have you make a down payment of anywhere from 10 to 20% just so that you are bought in and you're not just going to one day up and leave the house and be stuck, stick the bank with all this money that they've lost. So now the Martins are paying 15%. So 15% times the 249,000 turns out to be $37,350. So then the B part to the problem says, okay, they're making a down payment of $37,350. They are borrowing the rest. So what do I do with that $37,350 in order to figure out how much money they are borrowing from the bank? Yeah, the amount they're mortgaging is the amount of the house, $249,000, minus the down payment, which is $37,350. And that turns out to be $211,650. So then the last question deals with the points. They are paying 2 points for whatever reason. So all a point is it's a percent of the amount that you're borrowing. So if they're getting 2 points, that's 2%. So they are going to take, we're going to take the 0.02 times that amount they're borrowing, which is $211,650. And that is $4,233. And again, that's a lot of money. But if you're in the Martins position and you know that you're getting ready to settle in for the long term, it's going to be a lot less money than the interest on the $211,000 is going to be over 30 years. So they're gonna save a bunch. Okay, so that is just the basics. So then you see on the first page, the way we're going to calculate the amount of money you would pay per month. So let's say you are leaving here and you're in the middle of a house deal and you want to know how much your monthly payment is going to be. The monthly principal and interest. So this is not counting, again, sometimes if you're buying a first house, places will make you buy mortgage insurance. My wife and I had to do that because they want to make sure that you're not going to up and run on this mortgage. So this is just counting the principal and interest payment. Other banks will also have you set up a little account for your property taxes and things. So it just depends. Some banks are a little more involved than others. So again, this is just basic. Notice this about this chart. If you remember our installment buying chart, when we were talking about buying cars, that was the amount of finance charge per $100. This chart's a touch different. This chart's telling you the principal and interest per every $1,000 that you have borrowed. Okay, so it's groups of 1,000. So there's some popular numbers of years and interest rates. And we're going to do this. So be ready to refer to that front page. So here's my first problem that I'm going to do. We're going to finish up with the Martins. The Martins want to obtain a 30-year mortgage at an interest rate of 7%. So we're going to determine their monthly principal and interest. Okay, so it's a 30-year mortgage at 7%. So I'm going to go back to my table. A 30-year mortgage at 7%. So here's the 30 column. I'm going to go down to the 7% row. That is this right here, 6.65302. We're going to use all those digits. 6.65302. That is how much money the Martins are going to pay every month per $1,000 they're mortgaging. So we then need to say how many groups of 1,000 are there? Well, going back to my first problem, the Martins are mortgaging $211,650. So that is $211,650. Then I'm going to divide that by 1,000. I'm going to divide it into groups of 1,000. Okay. Very similar process as we employed back in section 3, or I guess section 2 when we were talking, one of the sections when we were talking about installment buying. So then this is going to tell us how much the Martins are going to pay every month for those 30 years. And then at the end of the 30 years, they will be free of that and the house will be theirs. They can make all the money on it they want. So 211,650 divided by 1,000, that is 211.65 groups of 1,000. Then I'm going to multiply by that 6.65302. It's a lot of decimal places. And we get this, $1,408.11 every month is going to be their principal and interest payment. All right, so what you're going to do next is you're going to do exercise 1. You're going to help Sherry. Sherry's buying a condominium that sells for $135,000. To obtain the mortgage, Sherry has to make a 20% down payment. She then obtains a 15-year mortgage with an interest rate of 3%. Oh, by the way, I've been giving you like little life lessons that you may or may not care about. Here's the life lesson with mortgages. Never get a variable rate mortgage, okay? Always get, if you ever do buy anything, always get a fixed rate mortgage. That way you know what your interest is going to be. Variable rates or balloon interest rates, any sort of fancy term like that, avoid them. Okay, they are going to make you lose money and they're terrible. Anyway, that's just an aside. All right, how am I going to calculate Sherry's down payment? What do I do?
Multiply 0.2 with $135,000.
I understand. Sometimes it's just hard to spit that out. I get it. I'm like that. Yes, you are exactly right, though. We're going to multiply the 0.2, the 20% down, times $135,000. So that's 0.2 times 135. And that turns out to be $27,000 that Sherry is bringing to the table. So far, are we so good? Anybody got a question, comment, or concern? All right, the B part to the problem says, what's the amount of the mortgage? What am I going to do to calculate the amount of the mortgage? Okay, I'm going to take the $135,000 that the condo costs. I'm going to subtract the $27,000 that was brought to the table, and then that's going to be something, 108 maybe. Let's just make sure. $108,000 is being mortgaged. Now here's the new part. All of that is stuff that I would expect you to know how to do by this point in the chapter. The last part is what's the monthly payment for principal and interest. So we see that it's a 15-year mortgage at 3%. So I'm going to come over here. 15-year mortgage at 3%. That is this 6.90582. 6.90582. That is her monthly principal and interest payment for every $1,000. And we see that she's borrowing $108,000. So that's clearly going to be 108 groups of 1,000, but I'm showing you the full setup. And so we'll divide that by 1,000, and then we multiply by 6.90582, and that's going to be $745.83 per month. That's the essence of what I want you to know for this chapter. So we've got 2 more problems that we're going to go through, and then I have one other thing to point out to you about mortgages and their interest, and then we are done with chapter 10. So if you would, exercise 2 is pretty much the same thing. You're just going to be looking at a different part of the chart this time. Yeah, probably should have put the extra zeros in there. Okay, so same sort of thing. So the Diorios are purchasing their home for $199,900. They're obtaining a mortgage, and they have to make a 3% down payment. They obtain a 30-year mortgage with an interest rate of 4.5%. So we're just doing all the same things for the Diorios that we did for the other 2 problems. The first thing is, what is the required down payment? So this time the down payment is 3% times the $199,900. So it's just a matter of throwing that down into the calculator. And that turns out to be $5,997. That's the down payment. How much are they mortgaging? Okay, well, we're going to take the $199,900 and we're going to subtract the $5,997. And so when I go ahead and I do that, that's going to be $193,903. Okay, great. Again, I think that's pretty standard stuff. Not too big of a deal. Here's the new bit. What is their monthly payment going to be? The principal and interest. So the Diorios, they've got a 4.5% interest rate for 30 years. So we're going to come over here. 30 years at 4.5 is 5.06685. So 5.06685. And that's for every group of 1,000. So they're 193,903. We're going to divide that by 1,000, every group of 1,000. And this is going to give me what they're going to pay every month for the 30 years, unless they pay their principal down and end the mortgage early, which we'll talk about in just a minute. So 193,903, divide that by 1,000. That gives me 193.93. Then I'm going to multiply that by the 5.06685. Boom. And that's $982.61. All right, last thing. Almost last thing. You're going to help one more set of people, the Boldens. They're buying a house for actually $245,000. So sorry, for some reason I left those zeros out. They're going to pay a down payment of $45,000 from their current house sale. So they're going to attain a 20-year mortgage at 4.5 interest rate. And to get that rate, they had to pay 1.5 points. So there's just two problems for you to do right there. The first is what is the amount of mortgage? What I mean by that question, I should have asked it better. I want to know what's their monthly mortgage payment. I want you to use the chart and figure out. And then what is the cost of the 1.5 points?
I know that. But I got the thing.
You got what?
That's wrong. With the, I got the 980.
Yeah, so I think what I did on the previous one is I think I put 193,930 instead of 903. So that was a me thing, divided by 1,000 and then times the 5.06685. So I got 982.47. Is that what you got? Or yeah, would then round up 48. So whoever's watching on the video, sorry about that. I hit the numbers in the wrong order. Here I put 930 instead of 903. So order of digits matters. So what this really is 982.48. Okay, so on this problem right here, the Boldens, they're buying their house for $245,000. They've paid $45,000. So they are mortgaging, they are taking out a loan for $200,000. So I kept the numbers nice and clean right there. So the first thing I asked, what is the amount of the mortgage? And I told you I just asked that poorly. What I want to know is what's the amount of their monthly principal and interest. So I'm going to go to the chart. I'm going to look at the 4.5% interest rate for 20 years. So 4.5% for 20 years. I come over here, 20 years, 4.5%. That's 6.32649. 6.32649. So 6.32649. I think I remembered that right. And then they are borrowing $200,000. And I'm going to divide that into groups of 1,000, which is just going to be 200. But again, I'm showing you the setup so that there's no concern about that. So hopefully I can enter the numbers into the calculator properly. I'm having a little bit of a bad run the past couple classes. So 200,000 divided by 1,000 is 200 times the 6.32649. And that is $1,265.30 that they're going to pay every month. We're told in the problem that in order to get that rate must be lower than the federal government has set the interest rates at. In order to get that rate, they have to pay 1.5 points at the time of closing. So points are just, each point is a percent. So 1.5 points is 1.5%, so 0.015 times that amount that they borrowed, which was $200,000. And so 0.015 times $200,000 is $3,000. So that's how much they had to pay to lower their interest over the course of the loan. So then the only other thing I have to tell you about this is, again, just a little bit of life advice. If you ever do take out a mortgage because you've bought something, that's potentially a good decision. If you're going to be somewhere stable, because in general, mortgages are going to be less than rents at places, especially in a market like now. The thing to maybe think about doing, though, is if you can pay your loan off early, you're saving a lot of money. I just want to, in the example 2 for the Martins, I just want to show you the value of paying off your loan early. Like my wife and I, we had a mortgage and we just made a commitment that for several years, we didn't take vacations and we didn't go out to dinners and we didn't drink Starbucks because we wanted to long-term save money. So we wanted to pay our mortgage off early because we wanted to be able to enjoy earnings later. My wife's a teacher, I'm a teacher, so we're pretty just normal as far as income. I don't have any secret income. So for the Martins, they have borrowed this money for 30 years. So that means you're going to make 12 payments a year for 30 years. Their payment is $1,408.11. That's every month. They're going to do that for 12 months a year. And then they're going to do that for 30 years. So this is going to give me the amount of money over the course of 30 years that they're going to pay. And it's going to be significant because, they're paying to live there. So 1408. So I'm just using my calculator now, 0.11 times 12. That's how many payments every year. Then we're going to multiply that by 30. So over the course of 30 years, they're paying $506,919.60. And the reason I bring that up is if we think back to that problem, they borrowed $211,000. So we're going to subtract that. And this is going to give us the amount of interest that they paid. So this is the real cost for them to live in that house for 30 years. So it's the $506,919.60 minus the $211,650. So the quicker you can pay off that 30-year loan, you can see that for the Martins, that 30 years was $295,269.60. So a significant amount. So the value of saving, it goes back to, if you remember that chart that I gave you for investing. If you invest a little bit when you're young, given all that time, that turns into a lot more money than if you don't invest while you're young and you wait till you're older when you have less time. The same thing's kind of true here. If you scrimp a little bit, if you take out a mortgage and and pay that down sooner than 30 years, you're going to save a significant amount of money by the time you get to the end of the loan. Anyway, that's the end of the Perksters